Hi, morning everyone. Um, Welcome to another STANLIB economic update. Geez, there's a lot going on. Let me just get my presentation up here. All righty. Thanks for joining this morning. I see quite a few people are still dialing in, but hopefully everybody's connected within the next couple of minutes. All right, so as I said, a lot going on around the world, particularly obviously the US. Huge amount to update there in terms of inflation, what's happening to their bond market, interest rates, having a massive global impact. And then the Russia-Ukraine crisis. I don't know how this thing ends. It's very difficult to kind of come up with how it plays out ultimately. It's certainly carried on longer than I would have expected, and I guess most people would have expected. And while the intensity has eased, there isn't really an end game in sight necessarily, and that I think has to be a very substantial concern. So we'll talk about that a bit. We'll talk about China's lockdown. China, they put Shanghai into a lockdown for COVID, a very substantial. They confined something like 25 million people to their homes, massive lockdown. And China's obviously still doing this COVID lockdown policy to the extreme. It's not that the infection numbers are exceptionally high. They've obviously picked up quite a bit, but they're not for the size of their economy, the size of their population. The infection numbers are not ridiculous, but clearly they don't want this to get out of hand. So quite a lot happening there, and that's hurting the Chinese economy. So we'll talk about that a bit. And then we'll talk about South Africa. Not a lot of new stuff happening in South Africa. We're kind of in a wait and see mode, waiting for government to effect policy change, waiting for policy implementation. It's terrible, kind of drifting along. There's some pockets where there are some positive developments. One or two interesting dynamics around our bond market, which I think is worthwhile paying attention to. But in terms of outright growth, employment, very little to get excited about. If we did obviously start to implement policy, things would change quite quickly, I think. So I'll talk about that. As usual, we're going to use quite a few charts. The charts and the presentation are available if you want a copy of that. So there is a recording of this being made, and obviously the charts are available. Also, if you want CPD points, you've got to stay on the call or on the video for pretty much the whole thing in order to qualify for the CPD points. Yeah, so we're going to use the Q&A section. So if you want to ask questions, please pop that into the Q&A. I'll be monitoring that as we go along. The chat system is not operational, so please use the Q&A. And I can't promise to get to all the questions. I'll certainly try. And then maybe at the end, we've got some time where I can scroll back and have a look and see if there are specific questions. All righty. So you should be able to see the charts up on the screen. So let's start where the global economy is at. What you've seen is essentially confidence weaken quite considerably. There aren't a lot of global surveys of economic confidence. Each country has their own sort of survey. So the only real one that looks at, kind of tries to survey the world economy is the one on the screen at the moment. And that comes out monthly, and it's up to date, right? So this is actually an April number. And you can see that it's come off quite sharply. Understandably, a lot of that weakness relates to the Russia-Ukraine crisis. But intertwined with all of that are some significant concerns that are building around, obviously, inflation. Most countries have got a substantial inflation concern. There's significant concerns around higher interest rates pretty much everywhere in the world. And I guess more than that, there's a concern that as interest rates move up, that ultimately that pushes key parts of the world economy into recession. So we have seen global growth rates being revised significantly lower, not to the point of a recession. So mainstream economists are not forecasting that the major economy is going to recession, including the US, but they're certainly forecasting a marked slowdown in economic activity during the remainder of this year and particularly into next year. And obviously, as interest rates go up and as businesses and households respond to those higher interest rates, then clearly there is a risk that ultimately we do go into a recession. So I think the confidence numbers are reflecting all of that, intertwined with the Russia-Ukraine thing, intertwined with COVID, which persists, right? COVID hasn't gone away. The battle against COVID hasn't been won. You can't declare victory, if you like. I guess for many countries, they've got to the point, including South Africa, where you've kind of got to learn to live with COVID, whatever that means. And I think many countries are adopting more of that as a strategy, and that's probably appropriate. Vaccine levels, certainly in South Africa, have been disappointing, and in many countries, they remain disappointing. That's not due to a lack of access to vaccines. That's just, I think, apathy from households to engage with the vaccine program. And there's always this risk that another variant comes along, right? So there are a couple of new variants around, but nothing that is causing a massive concern. But clearly, at any point, there could emerge a new variant, and that would undermine a lot of the economic activity that is around. So when you put it all together, geez, there's a lot to look at, and markets are being hammered by a range of factors, and it's become increasingly difficult for fund managers to digest all of this information and make a really informed decision. I've noticed that a lot of fund managers have adopted a kind of let me do nothing approach. And that's probably not, it hasn't been a bad strategy, because you would have been whiplashed by a number of events, right? So I think that's probably been a decent outcome, but it's clear that the outlook for global interest rates has evolved considerably. There's going to be a much more significant increase in interest rates, and that's going to cause economic activity to slow. And are markets priced for that? And there's a big question mark. And so I think fund managers are going to be increasingly forced into making some critical decisions here. Testing time. Fund managers are earning their money. Okay, so confidence doesn't look good. It's not at a recession level. You can see when in 2009, how bad confidence got. That was a global recession. And then obviously with the COVID era, it got particularly bad in 2020. So we're not at that level of depression in terms of economic activity, but anytime this number falls below the zero line, goes negative, we start to pay attention to it, and it's in that territory. And a lot will depend on how the Russia-Ukraine crisis gets resolved from here. So let's focus on the US. I'm going to spend quite a bit of time talking about the US because it's that critical. And I'm not going to go through all of the economics around the US. I'm assuming that a lot of people on the call are fairly familiar with that. But what I want to focus on is their inflation problem and what they're trying to do about it on a monetary policy perspective, and why that matters so substantially for the rest of the world. And I think the critical thing is to recognize always that if the US Federal Reserve puts up interest rates, it always puts every other central bank under pressure, because they have obviously the reserve currency for the world. And a lot of central banks focus on what the US is in terms of US is doing in terms of their interest rates in order to understand the direction for their own interest rates. And you can debate whether that's right or wrong. But in the financial markets right now, it's absolutely critical as to what the Federal Reserve does. So let's understand some of the inflation issues. Now, the US economy has done exceptionally well. We know that. They've recovered very strongly from COVID. The US economy is the biggest it's ever been. And that recovery has been exceptionally impressive. And we've discussed the reasons in the past for that recovery, which has a lot to do with the fiscal stimulus program and the social payments, particularly the unemployment payments, right? So you would say that that was a success, and it's resulted in a very strong economic recovery. And that recovery at the moment seems intact, right? But clearly with risk to the downside as interest rates rise. Now, when it comes to the strength of their economy, there are two key areas that the US is overheating. And there was a suspicion months ago that these areas were starting to overheat, but it's very clear now that there is an overheating factor taking place in two areas, and that overheating needs to be cooled down. And the only way to cool that down is interest rates. So the Federal Reserve actually has no choice now. They have to raise interest rates in order to cool down the economy. And if they don't raise interest rates fairly aggressively, all that's going to happen is that the inflation problem is going to intensify, it's going to broaden out, and that ultimately the inflation will do the work of the interest rate. In other words, inflation will start to undermine economic activity and disrupt a lot of factors that have been positive in the US. So in my mind, the Federal Reserve has no choice. They've got to start to normalize interest rates more aggressively. Now, they've raised interest rates initially, but they've got to be a lot more aggressive. And the inflation concern that the US is not an oil concern, right? The areas that I'm talking about overheating that are feeding into inflation is not oil. Oil is a factor for everybody, but I think most people recognize that oil inflation is going to be transitory, is going to be short term, because even if the oil price stays at $100 or stays at $120, as you stay at that level over a year, you end up with a zero inflation rate. So the impact of oil on inflation will dissipate. But the US has much bigger problems for the inflation than oil, way, way bigger than just oil. Oil is adding to the problem and making the numbers quite excessive in the US and around the world. But the US has two other very critical problems. So the first problem is their labor market is overheating. The labor market is way too strong now. And obviously, initially, you want your labor market to be good. You want to add jobs, you want to recover your employment, you want to get back to full employment. But it's gone too far, and it seems to still be robust. And as a result, it's creating wage pressure and inflation pressure. And that's a very substantial concern. So let's delve into that in a bit of detail, and hopefully I can explain where this is coming from. So when you look at total employment, the US obviously lost the 22 million jobs during the first 6 weeks of COVID. So a massive decline in employment. And at that point, they went into a deep recession. And then they started to re-stimulate their economy. And that stimulus was effective, as we've said, and they've recovered most of those jobs. Now, when you look at total employment in the US, it's not back at a record level. So therefore, why are we saying that this thing is overheating? They're not even back at a level of employment that existed before COVID. The reason this is overheating is that in that time period from when COVID started, a huge number of people have exited the labor market. In other words, they don't want a job. They're not participating in the labor market. And the reason we think these people have exited is they've retired. There was a surge in people retiring in the US during the COVID era. And that retirement was sparked or brought forward, if you like, by COVID, where people said, look, you know, I'm thinking about retirement. I'm close to retirement. COVID has struck. I'm at home. Let me just retire. And that process of retiring has been made a lot easier by a wealth effect. So if you look at, I'm going to show you in a while, if you look at US house prices, they're at an all-time record high. The stock market hasn't done too bad overall. And because you've had a positive wealth effect, you're more inclined to retire because you're less concerned about your pension. And so a huge number of people have retired in the US over the past 2 years, and so they've exited the labor market. So what that means is that you don't have to go back to the same level of employment in order to get to full employment. And that's what's happened. And so the US has got to this point where unemployment is down at 3.8%. It's pretty much full employment in terms of the percentage unemployed. And on top of that, they've got these massive job openings, right? So job openings sit at 11 million, which means that companies are looking to employ 11 million people. And that's an all-time record high. Now, that's an extraordinary amount of people. So what it says is just at the time where people are retiring and they're exiting the labor market, companies are looking for the most number of people ever. So why are companies looking to employ all of these people? Well, for a simple reason, that the economy has been strong. The economy has recovered. I'm going back here just to remind you, look where GDP is in real terms, adjusted for inflation. So US GDP is the biggest it's ever been. And so you need a hell of a lot of people to satisfy that GDP. So companies are looking to employ people. They feel they don't have enough staff members given the demand they've got. But people have exited the labor market. They don't want to work. They've retired. So you end up with 11 million people 11 million people looking to be employed, but you're at full employment. And that creates a problem. So think about it this way. How many people are actually unemployed? What is the 3.8% unemployment if we translate that into numbers of people? We're talking about numbers of people that have fallen below 6 million. So you could say, look, 6 million is still a significant number, but when you consider the size of the US population, you consider the number of cities, that 6 million is spread throughout the country. It actually isn't that significant. And so think about the number of people, less than 6 million unemployed, yet companies want to employ more than 11 million people. There's a mismatch. So even if you employed everybody who was unemployed, you would still need to find 5 million more people to work. And you just don't have that. And so the labor market is overheating. The labor market is way too strong. Companies are looking to employ too many people. Bizarre, right? We would love that problem. But it's where the US finds itself now after a massive stimulus program, an unprecedented stimulus program. Now, the situation is compounded even more when you look at the age profile of unemployment. So when you break down this 3.8%, so remember the total unemployment is 3.8%, which is low. But that is not 3.8% across all age groups. The only age group that has a fairly high level of employment is the youth, right? People younger than 25, where the unemployment rate is up at 8%. But if you look at the other age groups, look particularly at that age group 45 to 54. That's a critical age group because those are people who kind of sort of know what they're doing. And those are a lot of people that you want to have in your business. But their unemployment rate is 2.2%. Now, how does that 2.2% compare with history? And it turns out that 2.2% is pretty much the lowest that age group has ever experienced. So if you like, that age group is clearly at full employment. There are very few people in those age groups that are available to work. So when you look at that 6 million people who are unemployed, it turns out that a huge number of those people are young people. No experience, very little experience. Many of them have not had their first job opportunity. And so it's unlikely that companies are going to find who they're looking for in that much lower age group. And as they look for people in higher age groups that are more experienced, they're just not going to find people. So now it is very evident that 11 million people that companies are looking to employ is an extra significant problem because they just can't find skills. So the US is now experiencing a very substantial skills problem. And so And so what happens under those circumstances? A couple of important things. One, it's easy to change jobs. And that's beautiful, right? The ease of being able to change jobs is great, because if you don't like your boss, you can simply say, stuff it, and walk out the door, and you know that you're going to be able to find a job quite easily within the next couple of hours, the next couple of days, the next couple of weeks. You're going to find employment. It's very likely that people have already approached you, tried to headhunt you to gain employment. And so if companies are not treating you decently, not paying you appropriately, you simply exit. You simply say, I'll take my labor elsewhere. And so what that does is it forces companies to up their game. It forces management to be more proactive, to think about what staff are up to, etc. If you've got a weak labor market like South Africa, you don't have that. And we see that all the time, right? Management doesn't have to worry about what staff's concerns are, because where are you going to go? Where do you think you're going to go, right? So having this strength in the labor market is a very powerful, and you don't need trade unions. If you've got this strength in the market, you certainly don't want a trade union messing with the market, because you want to be able to move and get salaries that you think you deserve, etc. And that's exactly what's happening. So it makes the labor market very fluid. And we've seen that in the US data. The other dynamic that happens is that companies have to pay up. If you want staff, you're going to have to find them, you're going to have to pay up. And in addition, you may, as a company, have to entice people out of retirement. And in order to entice somebody to come back from retirement, you may have to pay up. And that's the concern. And that concern is now being increasingly reflected in wages. So the data came out on Friday, the Atlanta wage tracker, which is a fairly good indicator of where wages are in the US, and that number has gone to 6% year on year. And when you break this wage down, according to people who have left their jobs, then their wage increase is even higher than this, right? So when we look at wages of people who have moved jobs, they're getting the benefit. If you stay in your work, you're not quite getting as large an increase, but it's still a decent increase. But what it tells you is that there's significant broad-based wage pressure in the United States. And we know in South Africa that the longer this wage pressure persists, the more that will translate into higher prices. And it's very difficult to turn this off. How do you go to your staff? Let's say that you've given your staff 6% salary increase. How do you go and say, no, I'm going to give you 2%? In South Africa, obviously that does happen. But in the US, it would be very difficult, because all of your staff would say, well, no, I can get 6% somewhere else. I'm leaving. And so this percentage becomes entrenched. And so you've got a significant wage spiral that is being created. And how do you stop this? If you're the Federal Reserve, what would you do to stop this happening? Well, the only thing you've got to do, which is very sad, is you've got to dampen down the labor market. You've got to depress on purpose the labor market. And the only way to do that is to put up interest rates, slow down economic activity, and make companies think about whether they want to employ people. Bizarre, but that's what you've got to do, because you've got to stop the upward spiral in wages. And that upward spiral in wages is intensified as the inflation data itself goes up. Now, we're going to have some critical data this afternoon out of the US inflation data. And I'm expecting the US inflation rate to be well over 8%, right? And you can imagine 8% US inflation, what's going to happen to wages? In this tight labor market, people are going to be saying, but inflation's 8%. I'm not even getting an inflation-related increase. I want an even bigger increase. So the Federal Reserve not only has a significant problem, but they have an urgent problem. The timing is critical. Yeah, they've left this way too late. They've made a massive policy error. Their policy error was they didn't believe inflation was going to be a problem initially, and now it's a major problem. So they're behind. They've got to catch up, which tells us the Federal Reserve has got to accelerate interest rate hikes. And that's a massive dynamic in the global economy, and it's having implications around the world, including in South Africa for our interest rates. Okay, so that's the first problem you've got in the US. The labor market is way too strong, and it's resulting in wage pressure. The second overheating is the housing market. So the US housing market recovered nicely, right? It was the epicenter of the crisis during the financial crisis. Subprime lending, remember that whole issue. And the US housing market collapsed, and it was in a very difficult space. But as the US recovered, so the housing market recovered. And then go to this chart in 2020, and can you see how the angle, the rate of increase changes? It almost starts to go vertical. Once COVID hits, this number starts to almost go vertical. What happened? Well, the US economy stimulated, right? The Federal Reserve provided significant more stimulus, including the buying of mortgage bonds. The government provided households with a huge amount of cash, and that additional cash and low interest rates, it just caused a surge in housing. Housing activity picked up, but more importantly, house prices picked up. And so over the last 2 years, house prices in the US have gone up quite a bit more than 30%. 30% in 2 years. And I need to stress that's 30% on top of a record price. It wasn't as if house prices were depressed before COVID. House prices were at an all-time high before COVID. And the COVID era gave house prices a further 30% upleg. That's impressive, right? Now, that upleg has been across the board. It hasn't been in just one or two areas. It's been in all the major cities. And the city I follow quite a lot in terms of this, because it kind of gives you the extremes, is Las Vegas. So look at what house prices have done in Las Vegas, and you can see the gyration in house prices. They were caught out by the global financial crisis. They were in a housing bubble, and then the bubble burst. And many people said it's going to take decades for Las Vegas house prices to go back to a record level. And it turns out in the last 2 years, house prices in Las Vegas have gone up more than 40%. So you're seeing these monster run-ups in house prices, and clearly an element of this is now speculation. An element of this is a housing bubble. So what's the problem with this, besides your overinflated house prices, is that when house prices go up this much, you're making it very, very costly to buy a house. And as you do that, people can't afford to buy a house. And because people can't afford to buy a house, they've got to rent a house. And because of that, rents go up. That's the problem. So when you look at rental inflation in the US, it has surged and it's approaching 5%. And rental inflation is the single biggest component within the inflation basket. And how do you stop rental inflation being a problem? Well, the only way is you've got to stop the house market going up. You've got to slow down house prices. You've got to make housing cheaper. So you've got to put up interest rates. But you can't just put up interest rates a little bit. That's not going to make housing cheaper. You've got to put up interest rates a lot. And so those end up being, besides oil, everybody's got an oil problem and there are other little quirks. But fundamentally, the US has two massive inflation problems, wages and housing. And those just happen to be the most critical elements to long-term inflation in most countries. And the only way it looks to me, if I look at this data, the only way you're going to rectify this problem is you've got to slow down the US economy significantly. And so interest rates are going up and it has global implications. A bit sad, but true. And this all comes about because the US Federal Reserve made a policy error. Initially, when inflation went up, they didn't think it was going to be a problem. They kept saying it was going to be transitory, and it turns out that was a mistake of judgment. And when the Federal Reserve makes that level of a mistake, it has global implications. Okay. So overall inflation, 7.9%. It's going to go over 8% this afternoon. So this number is not slowing down any time. And even if the oil price effect dissipates, you've still got significant underlying inflation pressure in the US. So US interest rates are going up. Now they've gone up a little bit, they've gone up 0.25%, but the Federal Reserve and financial markets have increasingly realized in the last few weeks that this has to go up a lot. So what is the market pricing in? The market is pricing in a very high probability that US interest rates end this year in a range of 2.5 to 2.75. Now, that's massive when you consider the range currently is 0.25% to 0.5%, which means interest rates have to rise very dramatically if the market is right. And when we look at what the Federal Reserve seems to be saying, they're sort of in line now with the market. They themselves are now expecting interest rates to rise very dramatically. So this expectation around US interest rates has narrowed to the point where everybody now accepts the US Federal Reserve is not just going to increase interest rates at every meeting for the remainder of this year. They're going to have to increase interest rates at times at 0.5% a go. So what does that look like? Let's assume that the market's expectation is correct. This is what interest rates in the US will do by the end of this year. And that's massive. That's massive when if you think a couple of months ago, interest rates were at record lows and people weren't expecting much of a move. And if you put up interest rates this fast, this quickly, it will start to have an effect. And it has the risk, right? That it doesn't just dampen down the economy, it causes the economy to go into recession. And so the risks around the US have changed. The risks around the US are now a debate about, does the US go into recession because the Federal Reserve over tightens interest rates? But the Federal Reserve has no choice. They've got to get inflation under control. And so it's becoming pretty much a self-fulfilling prophecy. And when you put up interest rates this quickly and relative to where they've been, it's going to have a damaging effect. And I don't think that's fully priced into the markets. I think the equity markets more recently have started to understand where this is all going, but I don't think it's fully priced in. Certainly not the risk. The risk is that the US goes into a substantial recession. On top of that, not only is the Federal Reserve going to be putting up interest rates, they're going to be reducing the size of their balance sheet, which means they're going to be reversing QE, and we call that QT, quantitative tightening. So the narrative is going to move from quantitative easing, so they finished QE, there's no more QE going on in the US. They've printed all the money they want, and they're now going to move into quantitative tightening, which is unwinding this. Now, the problem that the Fed has with trying to unwind this balance sheet is the balance sheet's enormous. Their ownership of US government bonds is over 5 trillion, which means that if you're going to start to make a difference, you've got to do a large amount of unwinding. And that's exactly what we think the Fed is going to do. And we think they'll announce that at their next meeting on the 4th of May. So you're going to have two effects, a big increase in interest rates and a significant unwinding of this liquidity, which means you take in money out of the economy. And again, what does that do? It has the risk of pushing the economy into a recession. Just as you added liquidity had the effect of boosting the economy, taking money out the system has exactly the opposite effect. And I think that bond markets in the US have finally woken up to this, right? If you look at the 10-year bond, it's moved up substantially, and you would argue that there's further upside risk to this number as you start to unwind that. And when you look at the 30-year mortgage rate, it's at the highest level in years because the bond market realizes, geez, the Federal Reserve is going to be selling a huge amount of bonds. So the dynamics around these markets have changed considerably. What we're unsure about is, where does this go? Where does it push the US? We know the US slows, that's clear. We know that US puts up interest rates. We know the markets have priced in a lot of that. But what we don't know is, does it push the US into an outright recession? That's not priced in. It's not priced into the bond market. It's not priced into the equity market. And how significant a recession would that be? And how quickly would the Federal Reserve have to start to cut interest rates? So there's a huge number of unknowns. But what is clear to me is that the risks are ratcheting up. And the longer the Russia-Ukraine crisis persists, the longer the Fed takes to push interest rates up, this becomes a bigger and bigger problem. And the markets are telling us that. The yield curve is telling us that. Now, there's been a lot of focus on this yield curve, and I'm focusing here on the 10-year yield curve. And the problem with this yield curve is that in history, it's been a very accurate predictor of recessions, not 100% predictor, but a very accurate predictor. In other words, whenever the yield curve goes negative, there's a high probability that what follows in 12 to 18 months is a recession. And last week, obviously, the yield curve went negative. So that's heightened this anxiety that all of this is ultimately just leading to the inevitable global recession. And I think there's a lot of merit in that argument. In the last week, the yield curve has gone back to positive territory, but it's perilously close to an outright negative level. And so the flags have gone up. The US could be heading to a significant recession. And so I would urge you, we've got to follow this very carefully because I don't think it's priced into the market. So what, from an economist point of view, what would we be watching to know whether this is going into a recession? Yes, the markets will focus on the yield curve, but what do economists focus on? Economists will focus on the underlying dynamic in the labor market. Because let's say that companies very quickly decide, you know what, I don't want to employ any more people. Those 11 million people that I wanted to employ, I don't want to employ them anymore. That would change the outlook for the US economy, and then the prospects of a recession would go up. In other words, it's very difficult for the US to have a recession if the US is still adding 300, 400,000 jobs a month. Last month, the US added more than 400,000 jobs. If that remains in place, the US won't go into recession. But if at any point companies decide, you know what, I don't want to hire these people, I think things have changed, the US goes into recession. So please watch things like weekly jobless claims, the intention to hire surveys, the actual employment data, the job openings data. That will all tell us if the labor market starts to weaken, the US will go into recession. All right, there's people asking about skill shortages and will attract people. Yeah, they have a more lenient immigration policy, but it takes time, right? You can't just close those skills gaps overnight. And many people have suggested that it's just convenient that there are, around 11 million people unemployed in South Africa, and the US is looking to employ 11 million people. So we could do a deal. But obviously this takes time, and you've got to find the right people. But yeah, there will be pressure and people will be moving to the US, and there are significant job opportunities, but I'm not sure that immigration will move quickly enough to really deal with the problem, right? Question asking the US stimulus did a good job, but too much. I can't agree with that more. The US stimulus was brilliant, right? Act of genius to get the economy going that quickly, but then you did too much. You gave people way too much money, and now you're paying the price, coupled with the fact that the Federal Reserve didn't see the inflation problem coming. Okay, so we've taken up a big chunk of time talking about the US, but I think it's critical. The rest of it we're going to go through a little bit quicker, which tells you we're not going to spend a huge amount of time on South Africa because there's not a lot of new stuff going on. Okay, so let's have a look at a couple of global things. The first thing is, yes, the US has an inflation problem, but everybody else in the world does, right? It's not just the US. The US has a different dynamic to their inflation, absolutely. The US inflation is a much bigger problem because it's embedded now. It's underlying inflation. Around the world, if you look at the inflation problem in South Africa, it's not embedded. It's food and fuel. And many other countries have the same issue. But the fact that everybody has an inflation problem, that's clear. And for most countries, it's been driven by the oil price. So developed market inflation, instead of being around 1 to 2%, it's now sitting at 7%. So many countries have this, and many countries are putting up interest rates, right? And if you look at emerging market inflation, that's gone to 8% instead of sitting in a range of 2 to 4%. And so everybody's putting up interest rates, not just because the Federal Reserve is hiking rates, but because they themselves have an inflation problem. And South Africa's inflation problem is going to manifest more clearly over the next couple of months. Our inflation rate will go over 6%. But in South Africa's case, I do think that the inflation is much more a fuel price or an oil effect and a food price effect. And I think some of that will be transitory. So we don't have the same dynamic around inflation, and that applies to many countries. The other thing that's still clear is this COVID issue, right? It's gone on to, people don't talk about it as much, and I think that's good, and the media doesn't focus on it as much, and I think that's good. But there's still a number of countries that are battling this, and as I said, China's gone into this massive lockdown, and that's undermining China's growth, and it's undermining world economic activity. I must say at this stage, South Africa's dealing with this much better than the average now. And even though our vaccine levels are not great, we're coping, right? The numbers are picking up again. So we've got a hint of a fifth wave starting to develop. And there are many people saying, well, we will have a fifth wave. But what's going to be more critical is this causing hospitalization and deaths? And so far, our deaths look okay, as much as you can say that about deaths. But the death numbers are on the high side of normal, which tells us that our system is coping. The healthcare system is coping. We don't have a significant problems. And I think that that will persist. So unless a new variant comes along that is a lot more dangerous from a health perspective, we could have a fifth wave, but I don't anticipate that it will result in massive lockdowns or in a massive hospitalization or other types of concerns. So I think we're dealing with this, but in the background, just please recognize that COVID hasn't gone away as a global issue. Many countries, as I said at the beginning, are trying to live with it and reduce travel restrictions and kind of get on with stuff. But the risk is still there. And many countries are now advocating annual vaccinations. It's just that it's, Russia, Ukraine has surpassed it in terms of debate. All right, so Russia's causing a lot of trouble. And that's bizarre when you consider that Russia's 1.7% of the world. Shows you how much trouble 1.7% of anything can actually cause, right? So Russia's always been that sort of country. It's always been a country that boxes above its weight level. And that's got a lot to do with the size of the military, although you would say the military has proven to be less effective than most people thought. But nevertheless, its role in the world economy is greater than the 1.7%, the size of their economy. And that's why they used to get invited to the G8 meetings, even though there is no such thing as a G8. It was always the G7 plus let's invite Russia. So Russia is having a very substantial destabilizing effect, and that effect continues on. And the conflict doesn't seem to be about to get resolved. And I think part of that is because Putin doesn't have something he can go home and brag about, right? And I think in order to get the thing resolved, you've got to give Putin some sort of victory, something he can brag about, even if it's a false victory. And the reason is this damn approval rating. So the approval rating, if you follow the presentations, we were talking about it last time as approval rating. And it turns out that when Russia invades a country, Russians love this. Now, we don't know for sure if this approval rating is just due to propaganda. In other words, the Russian media, because they've got a lot of state media and a lot of state newspaper, and there's a huge amount of propaganda in Russia. And so the Russian government does feed their population a lot of false information, particularly when it comes around to invading other countries. But there's another element to this, which is the Russian people like the strong man, like the hard man. They don't want to elect a weak leader. They want a powerful leader. That's been the case for centuries in Russia, right? Or decades at least. So Putin represents that, and his popularity would typically be 60 to 65%. And then when he invades another country, it would go up over 80%. And if you look at the approval rating now, it's gone up to 83%. And that's the approval rating surveyed after the Russian invasion of the Ukraine. Now, as I say, this might just be completely false due to propaganda or intimidation, but I suspect there's an element of truth to this. So what that tells me is that in order for Putin to go home, he needs to claim some sort of victory, because if you've got an element of people this approving, even if this is only partly true, right? If you've got people approving of your actions of invading another country, you can't go home and say, no, we didn't win anything. We lost thousands of people. The Ukraine army beat us. You can't do that. That's catastrophic for your popularity back home. And that win for Putin, that hasn't been worked out yet. And it doesn't feel like it's about to be worked out. So this thing could carry on for some time. And so this underlying unease with the oil price, etc., could persist. In the meantime, Russia's going through a very difficult economic time, but perhaps not as difficult as people imagine. So look at the currency. It sold off very dramatically in the first days and weeks of the war, but it's come back to the level that persisted before the Russia-Ukraine crisis. And a hell of a lot of this has got to do with two things. One, there are quite a few countries doing business with Russia, right? You've got these global sanctions, but we know, certainly in South Africa, that many countries are willing to break sanctions. Many companies are willing to break sanctions. So there's an element of that going on, and therefore there is money flowing into Russia. And the second thing is that Russia is still exporting a lot of their commodities. It's not as if all of those have been cut off, particularly obviously the oil and gas, and they're receiving payment for that by their own insistence in Russian ruble. And so there's been a lot of demand for ruble, bizarrely, right? Which means that the Russian currency has actually strengthened considerably. It's clearly false demand because the underlying dynamic of the Russian economy is incredibly weak, but it gives you an idea of how these markets can be manipulated. And on Friday, the Russian central bank actually cut interest rates. It cut rates from 20% to 17%. So you can see their response. They put up interest rates when their currency came under pressure. They had very little choice. And now they're cutting interest rates, and they may cut it further because at this stage, Russia's going to go into a very deep recession. We're starting to get data of that now. They're looking at a very substantial recession. And so they'll be wanting to ease that pressure on their own economy by cutting interest rates. So this isn't a one-way direction for Russia, right? And there will be people who want to enjoy a 17% return on their money by putting money into what was considered at that stage to be an exceptionally weak currency. And if you'd done that, you would have scored exceptionally well, right? You would have put your money into Russia at a very weak currency with a 20% interest rate, and you would be smiling right now. So it's not as vanilla as what appears in terms of the mainstream media. There are many people who are willing to break sanctions. Some of the other dynamics I think is interesting. The inflation rate in Russia is obviously ramping up. It's gone to 16%, and it'll ramp up further because of their own effects and partly because of the currency effect. But it's unlikely to stay at these levels partly because the ruble has strengthened, but partly because they don't have underlying strength in their economy. So I think the inflation rate will prove to be transitory. Their vehicle sales is collapsing. If I look at the latest number came out yesterday, I think, or on Friday, vehicle sales down 64%. And we're starting, as I say, to get some of the data, and Russia's going into a very deep recession. So as we get more and more economic data on Russia in terms of the crisis impact, it's going to be very clear that this is undermining the Russian economy longer term. At the same time, their credit rating has plummeted. Now, Standard & Poor's last week took their credit rating to default, what they call selective default, because Russia had to make a payment in dollars last week. And Russia said, okay, we'll make the payment on the 4th, I think it was the 4th of April. They said they'll make the payment, but they want to make the payment in ruble. And the debt, the nature of the debt, the terms and conditions insist that you pay in dollars. And because you're not making payment in dollars, you're making payment in rubles, you're considered to be in default. Now, Russia has 30 days in order to make that payment. Otherwise, they've outright default. But I see on Friday, Standard & Poor's discontinued their credit rating of Russia, which makes me think that perhaps Russia has discontinued the rating service that they get from Standard & Poor's. That's entirely feasible. So either way, Russia's credit rating is pretty much at default territory, no matter which credit rating you look at. And obviously that has longer term implications. It's got short term implications in terms of Russia's ability to make payment on this debt. And I've got no doubt they will default as the sanctions remain in place. So it's not as if Russia is able to weather the storm quite easily. There's some longer term implications here that I think we haven't quite worked out yet. All right, so for South Africa, obviously the crisis has benefits, and we've seen some of that, and we continue to derive those benefits, and those benefits are all through commodity exports and through our trade balance. And that will persist, and I think you'll see our trade balance go back up again, and it will look increasingly bigger. And so that is providing an uplift, and there's no doubt that it's helping with the rand, right? And right now you wouldn't expect the rand to weaken because you're getting this inflow from exports. You're getting this commodity price effect, and there's a handful of currencies in the world that are enjoying this commodity price effect, and that'll persist, right? Obviously, longer term, the rand will resume a weakening bias, but in the short term, it should be able to hold on to these levels. So that's a net positive. We know about the positive effect on tax revenue. And if you look at the tax revenue out of the mining sector monthly, it's been enormous, right? Particularly in the two key months, June and December, where most of the tax revenue from corporates are paid. Massive increase in mining tax revenue. And you would argue that that's going to persist into this year. So there's no doubt that South Africa is deriving some benefits from this. And we saw an additional benefit last week when Moody's put out their credit rating review. And Moody's has us, as we know, 2 notches below junk, but they had us on a negative outlook. And what Moody's said on Friday was, we're taking away the negative outlook. We're putting you on a neutral outlook. That's not an upgrade, right? An upgrade is a long way off, but Moody's is saying because of this revenue that we've received, pretty much because of the revenue we received from the exports, mining revenue, and because government took a lot of that revenue and used that revenue to repay debt. They didn't use that revenue to go on a spending splurge. Some of it they did, but most of it, well, let's say half of it, they used to reduce debt. Because government made that decision, Moody's said, okay, that feels better. We're taking away the negative outlook. And if that persists, at some point, we'll get a credit rating upgrade. So there's no doubt that we are enjoying some benefits from the Russia-Ukraine thing. And those benefits are not insignificant. And obviously, it would be beautiful if we could find a way to really capitalize on that. Unfortunately, we're not. And so this is where South Africa kind of gets stuck. And in the last couple of minutes, I just want to highlight this issue of South Africa being stuck. And how do you unstick, which is not a word, South Africa, or not a phrase. So how the hell do you unstick South Africa? Well, at the heart of it, our economy tried to recover, and it's not back to where it was. It's 1.8% below, which means we need all of this year to get back to a GDP level that existed prior to COVID. And the level of GDP before COVID was not great. So we can't brag about that, but it tells us that our recovery path has been difficult. It hasn't been smooth, it hasn't been easy, and there have been a couple of things that have hurt us. The looting last year hurt us. The load shedding absolutely hurt us. But fundamentally, what's wrong? What's wrong in South Africa? And you can encapsulate that in 2 charts. The first thing that's wrong is we just can't add jobs, right? We lost this 2.2 million jobs. We tried to add some jobs back, and we've made no real progress on this. So today we sit 1.8 million jobs below where we were before COVID started. And I'm sorry, this economy will not be vibrant until you at least add back those jobs, right? And how long is it going to take to add back the 1.8 million jobs? If we add jobs at 400,000 a year, we'd be thrilled. But if you do that, it's going to take you 4 years plus to add back those jobs. We've done a lot of damage during the COVID year. A lot of businesses went out of business, small business went out of business, and a lot of companies cut jobs, and we haven't added those jobs back. So the labor market inflexibility, the inability to get people back into work, major hindrance to this economy. And it doesn't feel like that's about to change. So if you're saying, well, we want more vibrancy in South Africa, we've got to start to add these jobs back. That's the first major structural hindrance. We don't add jobs back in a hurry. The second major hindrance is we just don't invest in ourselves. And there's no way, absolutely no way, South Africa can be economically successful unless we invest in ourselves. It's just not possible, right? And this is what I find bizarre. And I try not to talk about politics too much, but in the end, you can't avoid it entirely. But I've sat and listened to 4 investment summits, presidential investment summits. And at each of these summits, the government, the president have bragged about how much investment they're attracting. And I think to myself, have you not seen the chart? Have you not seen the data? The data is telling us that the level of investment in South Africa is the lowest ever recorded, ever. As a percentage of GDP relative to the size of this economy, this is the least amount we are investing in this country. Yet we have 4 annual investment summits where we brag the hell out about investments. We tell everybody that there's a huge amount of investment going on. And that misinformation is incredibly unhelpful because it leads to a false expectation, a false interpretation. We're not making progress on investments. And to just back that up, let me show you a sector that if we were investing, this sector should be booming, and that's the construction sector. Now, this is dismal. This is dismal in a country that is desperate for infrastructure. Look at growth in construction activity over the last 5 years. And each year for the last 5 years, construction activities declined. That is shocking. And in 2020, you can understand that decline, a massive fall off. We had COVID, but then you had a low base. And you would think you would have a pickup in construction activity last year. No, another decline. For 5 years in a row, this sector has declined to the point of oblivion. This sector is almost out of business, right? So if you're going to have vibrancy in your economy, think about the Soccer World Cup, how much we were building. This sector has to be part of it. And so I look at those two things and they linked, employment and investment, they absolutely linked. And you end up with an overriding conclusion. We are unwilling to believe in ourselves. That's what it comes down to. Companies are not investing. They instead are cutting costs, cutting jobs. They're worrying about the bottom line and they're doing a good job at it, but they're not investing. Government is unable to invest for a variety of reasons. And until such time as you invest and you get some vibrancy and people see that, this economy is going to remain sluggish. Now, there are some positives, right? The spectrum auction, very good. Government got, I can't remember, 15 billion rand. That's going to help government revenue. And we shouldn't see investment. The independent power producer program is moving ahead. The idea of taking the port authorities out of Transnet, that is a real thing that will materialize during the course of this year. And we could start to see some investment being announced around the ports. So there are initiatives underway, and government clearly has this intention, but oh my goodness, it is taking so long. And I think the falsehood of what we talk about is a hindrance. We need to be much clearer that this is an obstacle and we've got to do something more meaningful about this. The positive is, think about the bond market and the equity market in South Africa. Let's say that you start to get some of these growth dynamics right, which are all internally driven. Then you're going to get a very substantial uplift off a low base. Think about how construction would boom after 5 years of decline. Massive base, right? And then there would be a lot to invest in, and a lot of equities would be cheap. And when you look at the valuations of equities, they're not demanding in South Africa. And if so growth starts to come through, there's a lot of value you can unlock in South African equities. But for me to get excited about that, I've got to see more optimism around growth. The bond market equally looks interesting, right? You've got a running yield of over 10%, and you've got a government that is flush with cash. The risk of credit rating has abated. You've got a government that can reduce its borrowing requirement. And you've taken a lot of Eastern Europe out of the investment circle. People who would have been investing in Turkey or Poland or Russia, they don't want to invest there. Money's coming to South Africa. So our bond market looks interesting. So ironically, even though the economy is stuck, there's some investment opportunities. And I think we've got to just remind ourselves of that. And given the currency strength, some of those investment opportunities are domestic. We've got to pay attention to the global dynamic, to global interest rates. But it doesn't mean we exclude all investment opportunities. And when we look and discuss at our bond market, there's decent double-digit return on offering. And potentially a little bit of growth dynamic in South Africa, there are potential double-digit returns in equities as well. The last thing I just want to highlight is for the moment, our growth expectation is low, 1 to 2%. And I must say, I constantly search the data to see whether I can revise these numbers up. And if the data starts to come through and we see the projects and we see the unlock of regulation, these numbers will be revised up. And then I think South Africa will become a more interesting place in a world economy that has got a lot of concerns. The other thing I just want to mention is we don't have this underlying inflation problem. And I want to highlight through our rental inflation. Look at our rental inflation, sits at 1 to 2%. And this is the single biggest component of our inflation basket. So we've got some advantages. We've got nice inflows on our balance of payments. We've got nice tax revenue inflows. I don't think our inflation problem is underlying and embedded. Interest rates will go up, but I don't think they have to rise very dramatically. We've got a decent currency strength. We've got the makings of some projects that could materialize. The valuations are not demanding, not necessarily that depressing a place to be, but we need to find a way to unlock that. And I think that has to be domestically driven. It's not going to be unlocked globally. And that's what we're waiting for. We're waiting for government to basically get out the way, deregulate and implement the key policies they have to. So I know I've rambled on. I've covered quite a few topics. I hope that helps, sort of. I know we're sort of out of time. Let's just see if here's a question here. I like this question. Why does an inverted yield curve often lead to a recession? It's not that the curve itself being inverted is what causes the recession. It's what the curve is signaling that is interpreted as an impending recession. In other words, the long bond market is pricing a situation that's saying, ultimately, in the longer term, 10-year bond market is pricing the longer term. What it's saying, the message it's sending, is that it doesn't believe inflation is going to be a long-term problem. And therefore, it's saying that in order for inflation to not be a long-term problem, interest rates are going to go up, and those interest rates are going to cause inflation to not be a long-term problem. And how does it do that? Through a recession. So it's what the yield curve is signaling to us. And given that the US bond market is considered by many to be the most efficient financial market in the world, it's very difficult to just ignore it, right? Because markets give us messages, they give us information, they tell us something. And they're not always right, right? They're not always right. But it's a signal that you don't want to ignore. And right now, the bond market in the US, the yield curve, the range is signaling that there's a high risk of a recession. Let me see if there's any other questions. Yeah, is it good idea to move clients more into bonds? Yes. I think it's, if you think we've avoided the bond market, right, for good reason. Credit rating downgrades, government finances in shocking shape, very good reason to ignore the longer end of the bond market, but please consider it. We had our investment meetings, our asset allocation. I was listening to, if you've got a chance, please listen to Sylvester, who's his deputy in charge of our bond team. He makes some really good points on the bond market. And he was saying, you think bonds can give us a return of over 15%? And when I listen to the story, it's compelling, right? And you think about it, South African bonds, a 15% return, but we've got some big positives. Government, I promise you, is awash with cash. They don't have to borrow. They could stop borrowing, they'd have so much cash. So government's in a favorable position. The credit rating outlook has changed materially. It's not a credit rating upgrade, but we've got no longer risks of a downgrade. Government can pick and choose how they borrow. They don't have to even borrow internationally. They've got lots of domestic options available. That's not bad. And as long as the commodity prices hold up, government's going to enjoy very good tax revenue. And we think that investors have turned away from countries like Poland and Turkey and Russia and are looking at South Africa. Interesting dynamic around South Africa's bond market. It's something I think we should be considering. Question, will China be able to avoid a recession? Yeah, China's not big on recessions at all. The problem for China is not a recession. The problem is a meaningful slowdown in activity. And already, the growth forecasts are dipping below 5%. So still very good growth, but China has growth expectations well above that. And so that creates social pressure. If the growth rate is not there, it creates social pressure and also creates political pressure. And they've got a massive Communist Party conference happening end of this year. Think about it as a big elective conference. The Chinese authorities, the Communist Party bosses, don't want to have a situation where China is under enormous pressure. So expect China to try and re-stimulate their economy, even though they're trying to control COVID. All right, I've gone over time. I apologize. I hope all of that makes some sense. I know we rambled on a bit. Please, as I said, CPT points have been on offer. Presentation is available. If you've got something you personally want to chat about, please reach out. We can try and get back to you on that. Otherwise, have a good week and good luck in the markets. Some interesting dynamics. And as I said at the start, I think fund managers have to earn their salaries. Thanks, guys.